Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Monday, October 10th, 2022. And our top story today, we're previewing the upcoming Spark Conference, Digital Transformation and the Customer Experience. Today's show is powered by the Spark Institute. To learn more about the Spark Institute, its mission, its members, and of course, its upcoming conference, visit sparkinstitute.org. Well, Cindy, Linda, it's great to see you. Thanks so much for joining us on the program this morning.
Thank you. It's good to be here.
Yeah, it's great to talk to you. And Cindy, I want to come to you first because we're previewing panels today at Spark, and this is a really interesting panel about digital transformation as a result of COVID, and what's permanent, what's not permanent. You're going to be covering this along with Linda at your upcoming session at Spark. Let me start off by asking. We've just finished the pandemic, or at least to some, we finished the pandemic. And there has been a lot of change in the way that we conduct business. Just at the 50,000 foot level, how has COVID impacted transactional business within the financial services industry?
Well, I will say that administrators, advisors, sponsors have continually been looking for smarter ways to help millions of American workers save for retirement. Amidst all of the economic, the social, and the industry turbulence the past couple of years, we've all found ourselves revisiting long-standing operating models. But the thing that has remained consistent is industry consolidation, heightened competition, margin pressure, the technology and security requirements that continue to rise, and sponsors and participants who expect more products and better experiences. And then there's always new regulations for us to adapt to. And that's exactly what we want to cover at the panel this November, is to bring together the analysis and insights from leaders across the industry who leveraged the pandemic and other events as a catalyst to reimagine the way that they engaged participants, as well as to accelerate the adoption of digital technology, in many cases by several years, in ways that have had a big and tangible impact on participant retirement outcomes.
And Linda, I mean, this has been a transformational way, a transforming experience for so many Americans. And I want to kind of tap into some of the research you and your team are doing here. I mean, it is really, Linda, Cindy mentioned consolidation. We've always got new rules and regs, but this really has the industry moving even faster than it was already moving.
Oh, for sure. I think one of the things that we all are appreciating now is that the advent of using technology for business, different types of communication and participant engagement has gone from a necessity to being necessary. It's just part of the way you have to do business now. Your customers expect that. And the user experience that Cindy touched on as well is critical in that engagement quotient. Because if the experience is subpar compared to other types of digital engagement that these individuals are using, their usage rates are going to go down, their satisfaction is going to go down, and ultimately their success in terms of their retirement savings will be hindered, if not harmed. So I think it's one really important part for providers and advisors as well to recognize, is that the expectations of the end customer are so much higher now.
Yeah, and Cindy, I want to come back to you because Linda makes a really good point. You made a good point. Our expectations as customers, I mean, look, you and the three of us are chatting via Zoom. Zooming is in. People do most of their transactions now on a phone or a tablet or through the computer. Very rarely do they walk into the financial institution to quote unquote drop off a check. So these are expected. And so I would imagine it's very difficult, or not difficult, it's a challenge to continue to evolve and get ahead and meet customers where they want to be met.
Yeah, it's true. And what's so interesting is that as we come back to the new normal, and as it starts to really take shape, what we're finding is that there is a strong desire for a hybrid model, where the convenience of digital is clearly the expectation, but that in-person human touch is also an expectation for certain types of interactions, for certain questions, for certain levels of engagement. So there's a need to kind of take the best of both worlds, if you will.
Yeah, and Linda, I want to pick up on that with you. The human being, we're not going to all be replaced by chat robots. We're not going to be, the financial advisor is, this is my personal opinion, is not going to be replaced by just a robo-advisor. It really is a hybrid to be able to, just like going back to the office, you can work some of the time in the office and be with your teammates, but then you can also do things virtually. And that seems to really be a key theme here that is coming away from this transformation.
It is for sure. And it's really interesting to see that in our most recent research with DC plan participants, we saw their use of robo-advice has never been higher. Actually, it's an all-time high at our 2022 study. But the number one thing that the participants are asking for, and particularly the younger participants, millennials and Gen Xers, is access to a financial advisor. So they recognize that they like the convenience and the maybe the user experience of the robo advice, but when it comes down to having a more specific question or running through different scenarios, they're really looking for a person that face-to-face interaction or even Zoom type interactions, but a more personal interaction that brings the human element to their overall experience.
And Cindy, I mean, that human element, that personalization, that has been a key theme really in the retirement industry for a long time. And the time of just putting it into just a basic portfolio, or everyone's handled the same way, that really doesn't pass muster. And so that's question number one. And then you've got to have the infrastructure in place as an organization, like a record keeper or a financial advisory firm, to meet these customers. So it's not just meeting them, but you have to have the capabilities to meet them as well.
Yeah, 100%. I do think understanding enough about your participant base, your audience, their particular needs, concerns, fears, if you will, is a really important aspect of understanding how to communicate with them, which channel, even the types of messages or topics that are front and center for different constituents, as Linda was indicating. We've seen a huge interest in ESG investing, a big passion for a certain population of our participant base. Responsible investing is sparking, a great deal of participant interest. The inflation, market volatility, these are all topics that when you tie retirement outcomes to topics that are both timely, relevant, and of particular interest to an individual, like that is when you are going to see the biggest level of engagement, and that's when you're going to see better outcomes at the end of the day in terms of adequate savings rates, appropriate investment allocation, so just better outcomes overall.
Linda, just with everything that's going on from a digital perspective, we can't lose sight of protecting data, privacy. How prevalent is there a balance here that you're seeing in terms of the research that you and your firm have done, that okay, people want the robo or the hybrid experience, but they also want to protect their data and their accounts, because as we know, there are hackers galore, there's malware, there's so many different ways to steal information out there.
For sure. And one of the things that we found from both our interviews with plan sponsors as well as participants in the retirement plans is that the issue of data security or cybersecurity threats is rising to the top and very, very critical in their overall satisfaction with the providers and the financial services experience they have overall. I was not as surprised to see it come from plan sponsors, right? Because they're used to, have that fiduciary duty, need to be responsible for everything to do with their retirement plan. But one thing that was very surprising to me in our most recent research with participants is that the topic of data security was the most important factor in determining their satisfaction with their retirement plan provider. In the past, it's been things like investment performance or their account statements or website or customer service reps. Those are all still important too, but the thing that's rising to the top now is the data security. And that's something that, as Cindy was saying, you need to have the infrastructure in place to make sure that you're delivering on those expectations because your customers are very, very heightened in terms of their sensitivity to that, as you know.
Yeah, and Cindy, last question, and I'll let you guys go, I promise. I would imagine that this necessitates, from an RFP perspective, a lot of due diligence, not only around the capabilities, but as Linda said, it's the due diligence about what are you doing as an organization to protect the data. So you can have digital transformation, but that's great. But if you can't protect the data, that might be of concern to participants and the plan sponsors out there.
Yeah, absolutely. It's not only critical, it is really a fiduciary responsibility for the plan sponsor. The Spark organization issued a set of guidelines, which the DOL kind of largely adopted with a few changes. The DOL issued a set of guidelines for plan sponsors, for participants, and for providers in terms of the amount of due diligence that needs to be done, the types of checks and balances that we're responsible for conducting at an individual level, at a sponsor level, and as providers to protect the data of the retirement plans and assets and individuals that we're helping on their path to retirement.
Well, sir, I'm sorry, Cindy, go ahead and finish your thought.
Well, I was going to say that having the right infrastructure in place is 100% another critical element of that, and not only infrastructure, but to run end-to-end a secure program, but also a program that is going to communicate sort of the right message and the right channel to the right person at the right time, being able to do that at scale in an automated way is the other element that I would say is of critical importance for us to be able to sustain that kind of personalized and individualized experience in a secure and cost-effective way as an industry. Well, kind of those three elements all have to come together for it to work.
Yeah, absolutely. Well, we're going to have to leave it there. This sounds like a very exciting panel, very, very cutting edge, which I think is very exciting. Linda, Cindy, so great to see you. Thanks for popping by. And look, have a great panel at the Spark Conference in November.
Thank you.
Thank you.
Well, thanks, Cindy and Linda. And when we come back, we're going to preview the upcoming session on why CITs, those are collective investment trusts, have momentum. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
I was out of work for about a month. I wasn't there to help my husband. He had to take time off work. I have health insurance, but it doesn't cover everything. The AFLAC policy helped me while I was out of work simply because it took the stress and the worry off. AFLAC helped with copays, deductibles, and a lot of the upfront expenses. The AFLAC insurance helped relieve my family's financial stress.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. Today's show is powered by the Spark Institute. To learn more about the Spark Institute, its members, its mission, and of course, its upcoming conference, visit sparkinstitute.org. And joining me now to discuss CITs, Mike Dullaghan is with Putnam, and Rob Barnett III is with Wilmington Trust. Mike, Rob, it's great to see you. Thanks so much for joining us on the program this morning.
Hey, thanks for having us, Jeff.
Yeah, it's great. And we're talking CITs this morning, or collective investment trust. And these investment products, just for point of clarification, Mike, I want to start with you. They're not new to the retirement marketplace. There are a lot of 401k plans, et cetera. But they're seeing greater adoption in this space. And I guess I want to start with you. The first question, Mike, is why are we seeing greater and greater adoption of CITs?
Yeah, that's a great question, Jeff. And to back up the history that you shared just a moment ago, I've been on the planet for a little over 5 decades myself, and CITs have been around even longer than that. And what's interesting about that history is, though they started up in the Fortune 100 realm, they've gradually drifted down market. And as that's happened, you've seen what were pretty high investment minimums peeled away. So now, Jeff, they're literally just available for more people. More people qualify, so to speak. I mean, theoretically, you could even have a startup 401k plan be able to use CITs, whereas in the past, that was not possible. But I think the big issue is to think about whatever the product is, who likes to buy something when it's on sale? I think that, all of us. I see you raising your hand, Jeff.
I think we're all raising our hand on that one.
That's for sure. We all like to buy something when it's on sale. And so what you see with CITs often is they may even be an investment strategy that a 401k plan already owns, but the price of the management fee and all-in fee total expense ratio is lower than what it would be in a similar mutual fund product. So I think that's where, Jeff, you begin to quickly catch the attention of plan sponsors, is that chance to buy something that maybe even they already own, maybe even they already like, but buy it when it's on sale.
Yeah, absolutely. And I have to say, I've been on the planet for 5 decades as well, and going strong, I might add. Rob, I want to come to you now and want to get your perspective. Are there plan types or sizes that you're seeing growth in CITs? And obviously Mike shared his perspective, but I want to get your perspective as well. And are there particular asset categories like S&P 500? That's a real popular category where we're seeing great growth.
Yeah, thanks, Jeff. Appreciate the time today. And to piggyback off of Mike's answer, I think we're generally seeing that growth across all plan sizes and eligible investor types. So eligible investors today are defined benefit plans, defined contribution plans, and governmental 457 plans. Hopefully here in the near future, we're going to see legislation passed through Secure 2.0 that will allow for 403Bs to invest in CITs. And we're all rooting hard for that. And hopefully we can get Congress to come together and actually pass a bipartisan bill, which is out there for us. But we're seeing it up and down the spectrum for all plan types. And really what we're also seeing is broad use across all asset classes. So just like you would see in most plans, target dates are a big hit with CITs, but moving through your various Morningstar style boxes, we're seeing strong application of use across all retirement plan types in CITs.
Yeah, and we're going to talk about 403B plans in a second. Get a little shout out to the policymakers out there who, we're coming up on the midterms. We're not going to talk politics, but obviously there's the opportunity, the lame duck to pass Secure 2.0. Big props there. Mike, I want to come back to you because there are probably a lot of mutual fund managers who are watching the program this morning, and maybe they're curious. They're hearing, hey, there's great growth in the CIT space. There's opportunity. What's the basic process? We don't have time to go into the great details, but what's the basic process if I want to create a CIT or convert my mutual fund to a collective investment trust?
Yeah, so arguably you're going to need a strong custodian like what Rob from Wilmington Trust represents, because they are the backbone from an operations standpoint, from a technological standpoint. So you're going to want to make sure that you have a good partner, that's for sure, because they're going to help you from that standpoint. However, you obviously need to start with, well, do we have demand? And where is the demand coming from? As Rob so correctly mentioned, there's only certain plan types that can own CITs in the first place, and I won't go over the list that he already mentioned. But therefore, you got to make sure, do we have the right demand coming from the right place? And then once we set up this CIT, will it have enough money in it initially to be viable and to be attractive? And that's where you'd work directly with the money managers of the strategy to find out from them, hey, does this look like something that we would want to pursue in a CIT structure to complement maybe what we already have in the mutual fund structure? So again, that custodian, Jeff, is going to play a key role in helping once the decision is made at the asset manager level.
Well, thanks, Mike. That makes a lot of sense. And it seems like in today's environment, it's relatively easy to transform to a CIT. Rob, I want to come to you because I started in the U.S. record-keeping business 30 years ago. And it used to be that one of the barriers to any investment in a plan was it had to be able to be looked up in the Wall Street Journal. Now, we don't get a lot of us don't get the Wall Street Journal in paper form anymore, but the information available on a CIT is now readily available on phone apps, on the company website or the plan website. So are there still communications challenges out there for plan sponsors, employers, and or participants?
So what we've seen over the last 6 to 8 years is greater transparency of information for CITs, whether that's been through utilization of tickers, which we pioneered with the NASDAQ. So plan participants, plan sponsors, plan advisors can type in a ticker and go out on the internet, and whether it's Yahoo Finance or Google Finance or your stocks app on your iPhone, be able to look up price and performance information on CITs. So you're seeing a lot of better transparency and evolution from CITs in this space. And what you're also seeing is CITs being picked up in databases more frequently. So it's better access to information at Morningstar, better access to information at some of your other firms who are information providers to advisors and ultimately to record keepers and plan sponsors.
Yeah, you bring up some of those tools that advisors and consultants really help drive a lot of those investment decisions. And look, if they can't get the data, it's a lot harder to compare and contrast. All right, Mike and Rob, I want to end things where we kind of started, which is 403B plans. And unfortunately, 403B plans, they have a subset of rules, very unique to 403Bs. And look, we'll have to give credit where credit's due. The Treasury did change 403B plans dramatically in 2009, I think January 1st, 2009. So it's not all bad, but CITs are not yet allowed. And I think, Mike, you mentioned Secure 2.0. How likely, what do we need to do to get this over the hump with our friends in Congress and the U.S. Senate as part of Secure 2.0?
Well, so I think, Jeff, fair question. If you go to the background or the foundation of Secure 2.0, it's all about coverage, right? Expanding coverage so as many American workers as possible are covered by payroll deduction workplace savings plans. So truly, the Secure 2.0 is all about coverage. And we already all put our hands up when we said, who likes to buy anything when it's on sale? Why should there be an excluded group, rather randomly excluded group, when it comes to the potential cost savings available in CITs? It's hard to wrap your head around why we're taking, again, in many cases, educators from higher education and elementary education, quite frankly, K through 12 education, Jeff, and we're not allowing them to come into this potentially more efficient way to buy investments. It makes no sense.
Yeah, and Rob, just to pick up on that, it's about leveling the playing field. And one of the things around the 403B regs that were effective January 1st, 2009, it was to homogenize the 403B plan to make it similar to the 401k and the cousin 457B governmental cousin. I want to get your perspective on this. What do we need to do to move the needle? And I know you and Mike, both of your firms are very active in, I wouldn't say lobbying, but convincing and educating staffers and legislators.
Yep. Thanks, Jeff. And our job really is just to educate. Let the elected officials, the pros, make their decisions. But our job is to educate here. And I think if you go back to some of the earlier questions you asked us, so where are we seeing traction? We're seeing traction in smaller plans. And, if you go back to Mike's first question, he talked about how smaller plans are getting access. Well, what that does is it levels the playing field for smaller investors. And those are the investors who need the savings that Mike is referring to in this, because it makes the most difference. If your bigger plans with your bigger balances get savings, that's great, because they're using their scale. But these smaller plans have been able to use scale and being able to get that extra cost savings. That's something that those participants it's just as meaningful, if not more meaningful, to those participants. And so when you think about Secure 2.0 and 403Bs not being eligible, if we can get 403B eligible, right, teachers' compensation is a continued talking point. Whether it's every year, every collective bargaining position, these teachers aren't paid enough. And the way that we're impacting their retirement savings by not allowing CITs or lower cost investments is also hindering them. So ways that we can help people achieve a dignified retirement really is through approving this legislation and letting their advisors advise the plan sponsors as to what is the best path for those plans. Because that's where this really lies, is in the advisor's court, in the consultant's court, to do their work, to help the plan sponsor justify what's best for them, not necessarily legislation.
Yeah, well, this is a very important topic, and I'm jealous that I will not be in Florida to hear your Spark panel on this. I think that you and your fellow panelists will have a very interesting conversation on this, hopefully convince more and more people, and by the way, elevate the issue for legislators, regulators, everybody and above. Rob, Mike, great to see you. Thanks so much for joining us. Have fun in Florida, and we look forward to having you back on the program again very soon.
Thanks, Jeff.
Thank you, Jeff. Appreciate you having us. Have a great day.
And that wraps up this episode of BRN AM. Have a topic of interest, somebody you think we should talk to? Drop us a line, and don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, entertainment, and so much more, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, we'll visit our website, and of course, all of our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
But if you're tired of the same
Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.